We have a great panel here today to talk about Bitcoin in the capital markets era. And why don't we start by having our panelists introduce themselves?
Thanks, Adam. Thanks, everyone here. I'm Bill Cannon, a portfolio manager at CoinShares. I manage 4 ETFs, and we work with BitGo and an incredible team with you and Adam, and I appreciate your time. Thanks.
Hello, everybody. Excited to be here with this crew. And Adam, BitGo, thanks for hosting. My name is Jeff Park. Until most recently, I was the CIO of ProCap, which was a Bitcoin treasury company that went online last year. And then before that, I was the head of alpha strategies at Bitwise Asset Management, where I continue to be an advisor today.
Hi, everyone. Thanks for being here. My name is Anton Kozlov. I'm the distribution lead for the U.S. business at 21Shares. 21Shares is a specialist asset manager that's focused exclusively on digital assets. We're one of the oldest and largest issuers of crypto-backed ETPs. My role is really to help advisors and institutions with their crypto allocations to their portfolios.
Hello, everyone. My name is LeClair. I'm the head of Bitcoin strategy at Metaplanet, and Metaplanet's, I think, the third largest holder, publicly listed holder of Bitcoin in the world. And we are, embracing a capital market strategy to do so. Excited to dig in.
Great. Thanks for the introductions. Jeff, I want to start with you. So last year at this conference, Bitcoin was about 110,000. Right now, last I checked, it was about 76,000. So is this a great buying opportunity, or is there a structural shift?
That's the trillion-dollar question. Look, I think one aspect that's been a little bit disappointing to the start of this year is that there's obviously been a decline in general liquidity for Bitcoin, and we're waiting for Bitcoin to pick up liquidity. And so far it's been a little lukewarm. That being said, I think people are quick to notice that today, at least, a lot of the support levels have been found where we're not seeing the flush downs that we've experienced back in February and October, to imagine that there could be a potential floor to at least the desire for sellers to exit the market. I reflected a lot upon what this cycle means versus the priors, and the conclusion I've reached to is this. Bitcoin, I think, has this tendency to be a bit of a mirror, and what I mean by that is it reflects a lot about all the goods and the bads of the values that you put into it. And every cycle, there's like a new final boss at Bitcoin, and no doubt the final one post the launch of the ETF was that it was now part of the public policy arena as embraced by this current administration. There's a lot of good that can come from it, but I think also Bitcoin can manifest to the ugly side of what that means. And I think there's some ability to appreciate that the ideological battle for what Bitcoin represents might be being, tempered a little bit. And so the next catalyst, I think, to really just get some escape velocity, I think will require a turnaround of that sentiment. And most of the Bitcoin cycles iterate this way. So the first rush of investors were venture capital investors, right? And they're invested into the ecosystem for a lot of the underwriting of various technological call options. Bad things can happen from it, of course. It draws down. The next cycle was driven by market makers, the exchanges, the FTXs of the world. They're getting really excited. Of course, those things also have a dark underbelly too. I think this version is experiencing maybe a little bit of the underbelly of what it means to be a politicized asset. And so my hope is that actually if there is maybe a turn in administration, it gives Bitcoin a chance to reclaim its existence as an apolitical asset, and that could potentially revive a little bit of the ideological underpinning that feels maybe a little lost at this conference, as no doubt you guys see, versus last year when we had J.D. Vance headlining, and just the amounts of energy that has been around Bitcoin as a politicized asset.
Anyone else want to comment on that? No? Okay.
If I can add, just maybe from a more tactical perspective, I think we're right below the 200-day moving average for Bitcoin right now. So, we're up at kind of resistance. If we break through, the funding rates are negative pretty solidly right now. So there could be kind of a squeeze to the upside. That being said, we haven't really confirmed above the 200 days, so we're still below it. So,
Right. Dylan, so on-chain data is your world. What does the holder composition tell us right now? Are the long-term holders continuing to hold, or is there more distribution to come? And how has the ETFs changed how you analyze on-chain data?
Yeah, it's a great question. And so my past job before Metaplanet was kind of looking at a lot of on-chain data and writing research for it. And it's something we still follow and track really closely. I think along with the 200-day, I think, I like to look at like the cost basis levels. And so you can see kind of on average, the average cost basis of all Bitcoin ever, including Satoshi's coins, at the price they've last moved is like 55,000. And so we didn't quite touch that, but usually that's like a bear market floor. In terms of like the hot money or the short-term money, that average was like 80,000. And so if you kind of just think of bull and bear trends, we're kind of when Bitcoin's above that level of the kind of cost basis of the hot money, we're in a bull market or we're trending up, and vice versa on the opposite side. And so I think that 80K level is really important. I think most of the selling that we saw in the first quarter and residually over the last few weeks has been top buyers. So the smart money, the people that were buying at the bottom of the bear market cycles, they actually exited around 100K. If you kind of just look at most of the data, and the people that are selling or puking are the people that bought at 100K or above. And so I think that's tuned down a bit. A lot of that selling I think has happened. People that puked their coins have already exited. So that's along with the negative funding rates and the kind of the derivatives market fading the move a little bit, has us feeling pretty strongly about Bitcoin here.
And then Bill and Anton, you guys are both asset managers on two of the largest crypto native ETFs. How has the price impacted it flows in Q1? And then with Morgan Stanley launching theirs recently, how has that changed the broader ecosystem?
I think Q1 historically has been a little damp in terms of price. I think the reallocation after the new year and a lot of different kinds of factors that involve more, again, back to that kind of where are we going to put our risk on, in terms of I think they're setting up, then Q2 comes along and it's I think the price overall has been resilient. I think that the support levels, as Jeff has talked about, is there. I think risk on comes a little more back. I think there's a lot more I was going to say before, there was probably a lot more macro headwinds that we're encountering right now. I'm sure that we're all used to waking up in the morning and finding out what happened overnight, like the OpenAI this morning, right? There's just there's price movement involving with that. But overall, I do think that we're kind of probably trend a little higher. I think that the institutional involvement this year is a lot better than last year than we've probably expected. In terms of Morgan Stanley, like you say, I think that you got the power of the 16,000 allocators that now have access to not only Bitcoin on their available to them, but also at a great price. I'll just be blunt about that. And I think that really puts us, I love competition. I think that gets us improved, looks at ourselves and what we could do better. But I think that is overall an improvement in the overall institutional engagement of Bitcoin.
Yeah, and if I can also add, so if you look last year, Bitcoin's down 6%. We drew down about over 40% from all-time highs. That being said, I think if you look at institutional adoption, as Bill mentioned, I think looking at the 13Fs and kind of unpacking that, it's actually pretty positive. So in 2025, we had about 21 billion in total inflows across the Bitcoin ETFs. Q3 was over 12 billion last year. Q4 was about 1.1 outflow. And then Q1 this year, slight outflow with 500 million. In April, we basically just made up everything, all the outflows for the past few quarters. So we're at like 2 billion in inflows this year. So the other thing to kind of keep in mind is it's not just, that institutions didn't really sell off during the downturn. I think it's also important to note that the number of institutional holders has increased. Investment advisors went from about 1,300 total unique holders year over year to 2,000. And there's 2,500 total unique holders across all the Bitcoin ETFs. So that just shows that there's a broadening institutional adoption. Investment advisors are actually the biggest category segment with about 14 billion in assets in these Bitcoin ETFs. And we're seeing that continue. So I think that'll be a future catalyst too, as these institutions are marginal buyers of Bitcoin. And the buyer profile has essentially changed over the past like 5 years, shifting to more institutions. So I think that's going to be a catalyst going forward.
Are you starting to see more interest from the pensions, endowments, and foundation space? I'd say they're still very early, right? But I would expect it to be an educational phase right now. But are there more discussions trying to educate them on the benefits of allocating to Bitcoin, whether that be through ETF or spot?
Yeah, I mean, I think there's definitely discussions. I think they're still further down on the curve, as you mentioned. I think we're seeing kind of more interest from the investment advisor community. Further, just to the point we made before about price action, I think also hedge funds do use these ETFs pretty extensively for the basis trade. There's some outflows towards the end of last year with the basis tightening. But I think like overall, sort of the institutional allocators like pensions, endowments are starting to look at this more. But I just think it's really an education, and then there's a lot of sort of reputational risk internally for approving these products.
Yeah, I can add a little color to this too. One thing people underestimate and maybe underappreciate that we get to see on the front line is the difference between a principal investor and actually an agency investor, right? Which is, a lot of you guys in this room, you're probably principal investors. You're buying Bitcoin for yourself or your own kind of portfolio's growth model. But endowments and pensions, they're fiduciaries of other people's capital. So their incentive alignment is slightly different than just maximal total returns, which changes a little bit of the dynamics to what motivates and inspires them to take action. So I think what I would take note is, as I've observed on the front line, this year, more than any other year, we're starting to see institutional investors realize that Bitcoin's risk can be segmented slightly differently for the benefit of current yield. I think there's always this dynamic where with pensions, they need some construct of yield because their whole asset liability matching construct is built on meeting a return threshold. And so once you're able to convert Bitcoin, taking advantage of its unique feature like its volatility and scarcity to a language they understand like yield, to me, this is a big unlock of a new capital channel that can come in. And part of the great journey I think these treasury companies have been on is unlocking that through the preferreds, but also we're seeing it through ETFs, where if you're able to launch covered call ETF type things on the back of Bitcoin, you're able to securitize Bitcoin risk a little bit differently for the payoff structure that is more digestible to somebody who's not a principal investor, but a fiduciary investor. And the third point I would mention too on that point is the rise of these model portfolios like Morgan Stanley, where if you have like the ability to put Bitcoin through a conduit where you can make small 1% to 2% allocations as an advisor, it's a really easy way to take a little bit of that risk of potential volatility and drawdown and not feel like you yourself are at risk of then being, God forbid, fired for making a decision for 1% to 2% of someone's portfolio. So all of these things, I think it's important. Like when we talk about institutional investors, their incentives are just different than us in the room, me by myself for my portfolio, because their goals are really looking out for client interests.
Completely agree with that, Jeff. So you, I think it was last week, tweeted about Stretch and going to the semi-monthly dividends versus monthly, and how that's a game changer for more broadly in the industry as well as crypto. Why is this such an important move, and in your opinion?
Yeah, I think for all of us who are practitioners of the capital markets, recognize that there's always these hidden taxes in our system. There's actually probably a really good reason why Jane Street had a record 40 billion plus year, and that's because they're paying, we're all paying a kind of a public tax on accessing the conduits and rails of what our capital markets in the US has become. But credit also has these elements where by the virtue of the frequency of these current cash coupons and interest payments, you're basically involving in some kind of liability transformation. So if you're a corporate bond investor, these coupons are paid 2 times a year, right? So even though you're accruing yield, you're actually not getting paid for a while. And if you really think about what interest represents from the aspect of being a liability holder, you want that money now. You want it sooner than later, because the money you have now against the default means the money that you don't have to go back and try to seek recovery. So current income is always best. And I think what Preferred's that now strategy has done with STRC for the first time, as I have followed it, is actually allowing more frequent payments in a structure that's never been done before. So whatever your view might be on MicroStrategies, whatever your view might be on Bitcoin, it doesn't matter. Actually, it's a really good thing in the capital markets to motivate issuers to pay more frequently to the end investor if you can. And if you squint just a little hard enough, you'll realize that's actually maybe the whole mission of crypto at large, right? This idea of instantaneous payment that is frictionless to allow a streaming concept of income by block, not even by day or by weeks, but literally block by block kinds of technical constructs is really the holy grail. So no matter, like, again, what you might think of STRC, to me, that seems very much a crypto-like aligned mission. And it's good for all of us as participants of that to promote current income in the time where liquidity clearly is being priced at a high premium than ever before.
If I could just add a little bit to that regarding STRC, I think for those in the space in 2021 that were paying attention, or maybe analysts or market participants, one of the dominant themes or drivers or at least narratives was contango, the contango trade, which is you buy spot and you can sell Bitcoin futures, take no delta risk or price risk, and make at one point it was like 40% in 2021. And so a lot of people, a lot of Bitcoiners, the thesis was, okay, well, this is an ARB, and this is going to be closed by the fixed income market piling in. And the naivete there was that the plumbing wasn't set up. And so no serious institutional allocator or fixed income allocator was going to log on to FTX and buy Bitcoin and short the futures. It just wasn't going to happen, even Binance or the other perpetual futures. And so what's interesting now is we have IBIT, we have the spot ETFs, CME futures is more liquid than ever. But also, Saylor basically took this, crypto invented perpetual futures. They never expire. They roll, and they have a funding rate that's variable that ties it to the spot price. So if spot's $100 and the future is $130, then the longs are going to pay a lot of interest, right? And so this is the most dominant derivative in crypto. And the most interesting thing is Saylor essentially reverse engineered this instrument to go long Bitcoin futures, but he listed it on the NASDAQ, right? It's if you think about it, Stretch is a perpetual swap, Bitcoin and dollars, with a variable funding rate. It's essentially like Saylor listed the contango trade on the NASDAQ. And so I think this is a big idea, and people still don't really understand the instrument, I think, outside of our niche circles, but it's already the biggest preferred in the world, and it's less than 12 months. So I think that this is a really successful instrument. I would imagine the TradFi is paying attention with how liquid it is, and I wouldn't be surprised to see other even non-Bitcoin treasury companies maybe try to replicate the structure.
Thanks, Dylan. Bill, so many of the largest TradFi institutions are coming into the space, right? We mentioned Morgan Stanley earlier, JP Morgan, Schwab, the list goes on. What does the institutional plumbing look like now, and what's missing?
Right. Let's just start with, there's, I think, a lot of different levels. Let's just keep it simple, though. From the custody level, I think that, again, working with partners like yourselves at BitGo, I think you guys got that down. Every time I talk to somebody, they're working with BitGo. But I think the message there is that is already, there's a solid foundation in terms of how people can store crypto and what they want to do. Let's just move forward to trading, execution. Again, you guys are doing a great job. I think that's also covered. I think a lot of different avenues are there, a lot of different directions in terms of what you want to trade, how you're going to trade it, and then obviously fall back on the custody, right? I think what the next level that we're probably going to see is more from that probably needs to be improved on is more probably, I guess, vertically integrated or perhaps a one-stop shop, right? And I think that we're going to get there, obviously, but I think the partnerships needs to happen. Perhaps there's some silos that exist currently just from a regulation standpoint, but I think probably over the next 2 to 5 years, I think we're going to get some of those well-defined positions, or probably a better direction in terms of how we're going to achieve that. And I think once you get there, then it's really, you guys are, certainly at BitGo and certainly at the banks, they're able to get that trust that perhaps investors are holding back on in terms of fully investing in crypto and to see what they could do going forward.
I think an interesting development too is, at least from the ETF perspective, when the ETFs first launched, the SEC just approved cash, create, redeem model. So, towards the end of last year, an in-kind model was greenlighted. I think that's been very important, and there's been, we're seeing a lot of interest for, getting, for example, Bitcoin held on an exchange or in a non-custodial wallet into like an ETF, for example, and have it be under the advised workflow. And I think a further unlock would be enabling that for retail. So right now it's kind of prohibitive for retail. The minimum sizes are quite large, but I think down the road that would be very interesting in kind for retail as well.
Yeah, I'd agree. Dylan, we've started to see some of the prime brokers, they're taking ETFs as collateral. What about, when do you think banks are going to be able to accept Bitcoin as collateral for loans, commercial loans, mortgages?
It's a great question. Hopefully sooner than later, but I think it's happening. It seems like the banks are building out the custody arms. I think in general the trend is quite clear that Bitcoin as collateral is heading to the same thing that you could get with a basket of S&P stock or Tesla stock at Goldman, right? Or like Goldman private lending or prime broker, right? So that's SOFR plus 50 or 100 basis points, and right now the rates are a lot higher, right? So I think the traditional market still has yet to appreciate the 24/7, 365 nature of over collateralized Bitcoin lending and its settlement. And the crypto native firms that do understand this don't have quite the access to capital that the TradFi ecosystem has. So I think this is slowly but surely happening, and I think it's very, very bullish as Bitcoin continues to be unlocked as collateral, and that those rates head closer to Fed funds rather than maybe double digits.
Yeah, look, even those that are starting to get in, their hurdle rates are massive compared to where they can source cash against Bitcoin elsewhere. So that has certainly been a hurdle that I think as more firms get in, we'll start to see those rates come down from the large banks. Jeff, you've argued that the most institutional investors misunderstand Bitcoin's role in a portfolio, not as a risk asset, but a hedge against the failure of the monetary system itself. Sitting with the benefit of your experience, how do you think TradFi views Bitcoin today?
I think it's a continued sense of intrigue as well as more of an acceptance towards what I think long-time Bitcoiners have known is this growing sense of unease that something feels a little unstable beneath our quicksand. And day by day, I think the thesis of Bitcoin is just becoming a little bit more clear. So, as much as I think people are excited about sovereign wealth funds coming to buy Bitcoin, and you can find a million tweets of speculation about who the next sovereign wealth fund buyer is, I thought it was quite poignant that there was an announcement for potentially Iran wanting to collect their toll payments for the use of Strait Hormuz with Bitcoin. And if that's not sovereign adoption, the kind that Bitcoin is looking for to seek its permanence as the neutral store of monetary value, that money that is good for Iran is money that is good for the United States, I actually don't know what better form of sovereign adoption we're waiting for. And I think people are more accepting now of this view than for me to have said this 4 years ago and get thrown out of the window, saying I'm a North Korean sympathizer, right? Like it's actually become more socially permissible for me to be able to express at least this possibility. So I think that's good. But I go back to this construct. Bitcoin is still not everyone's cup of tea because it can feel a little bit amorphous in the jump risks that it exhibits. So this continuation of yield becoming a function to drive demand, I think is a powerful lever, and we're gonna keep seeing it. I don't know how closely you guys have followed, but sometime 2 weeks ago, MicroStrategy now owns more Bitcoin than the BlackRock iShares ETF. I mean, that is telling you that the incremental demand that is coming for this new cohort of Bitcoin investors is channeling a credit desire for yield through the preferred that underlying mechanism delivers for the purchase of Bitcoin. So that's fact number one. The other fact I would share is this week, IBIT options for the first time overtook market share for Bitcoin options from Deribit, which means most of now the hedging and speculating activities happening on the derivatives layer is on Wall Street. It's no longer offshore on Deribit. So I think that also points towards a sophistication of the kinds of institutional participants that are coming, which are interested in things like the basis trade and arbitrage and recognizing how the role of a volatile asset in the format of a derivative can actually fit into a portfolio construction at large. And so I think those two trends, strategy's success in acquiring Bitcoin at the highest level as a single issuer, IBIT options overtaking Deribit, all of this goes back to kind of, I think, the first point I started about the ideological battle of Bitcoin, right? What has become where we are seeing these kinds of undercurrents? So in a good way, that's how the institutions are choosing to express it. I think in some ways, there's a lot of folks who are wondering, is that actually what we want for Bitcoin's endgame? And this is kind of the moment where the price action doesn't surprise me. There is an inability for conviction to break out because both sides are somehow a little bit potentially adversarial in the long run to each other's interests.
To add to your point, Jeff, I think it was interesting when that Hormuz Bitcoin toll booth story broke, because it was like 2 hours after the Morgan Stanley Bitcoin ETF launched, and so it's like the two most polar opposite developments or kind of narratives, but at the same time, it's undeniable that like there's black market demand for Bitcoin, there's white market demand for Bitcoin, and so this is clear that this is everything that Bitcoiners. The crazy Bitcoin people 10 years ago said would happen. They're like, the big banks are going to embrace it. Countries that are outside the dollar system are going to embrace it. It's clearly happening.
And for the record, I am not a North Korean sympathizer. I'm a proud American with South Korean heritage. So I just wanted to make that clear.
So Dylan, last year was the year of the digital asset treasury. I think we onboarded like 100 of them. It seemed like kept our legal team and onboarding team busy. Obviously, Metaplanet, strategy, you guys are in the headlines every day. What's next for the digital asset treasuries more broadly?
Yeah, I think there's a general consolidation happening. I mean, natively in Japan, I think we're 90-something% of the market in terms of Bitcoin holdings. But it's been interesting. There was some kind of fast followers, like hot money copycats, if you will. A lot of them have actually come out and reversed course or apologized. So I think it does, if you're going to pursue a digital asset strategy or a Bitcoin treasury strategy with conviction and size, relative size for your balance sheet, that comes with a lot, right? And so the board has to be on board, the investors have to be on board, the executives have to be on board, and the mission has to be very clear. And so that's why I think strategy has been so successful. They're literally singularly focused. Michael will tell you, Dylan, any other idea except raising capital to buy Bitcoin is a dumb one, right? And so it's clear that they've turned into a monster by following just that simple conviction. So for us, I think our roadmap is we want to be listing preferred instruments. We have a pre-IPO instrument, but it's really, I think, for us, and I think for the Bitcoin treasuries companies in general, last year was more of a story of a common equity capital raising. I think the future is common equity capital raising as well, but it's also tapping into that latent fixed income market, especially in Japan, where there's not even a junk market. It doesn't exist. So a 6% yield would be junk, high yield, see nothing like it. And so I think that's where we're really excited. I think things take time on the regulatory front, so we're playing the long game in Japan. But in general, I think it's the winners are going to kind of consolidate in terms of liquidity and size and balance sheet. And I think increasingly lean on instruments like Stretch or the preferreds as alternate sources of funding.
Great, thanks. Do you guys think the 4-year cycle playbook still exists, or are we in a new territory here?
Really quick. I would say it's kind of muted. And I think just because, especially over the last couple of years of the institutional engagement, I think everyone in the room probably will agree to some type of that. In terms of just an overall, let's just say, dealing with mining, in terms of halving and everything like that, I took a look at what, I wanted to know what the halving was going to be in 10 years. It's going to be 0.4 Bitcoin. It's just, or I should say 0.4 the block. And I think that it's priced in. I think that in terms of like what we're looking at in terms of the cycle, but I also think that it's just muted. It's just going to be a little more relaxed. I think we probably face more challenges from a macroeconomy at this current point than before, and we'll see how next year goes. I mean, even like let's just look at the later on this year with the midterm elections. Perhaps this environment will change a little bit, next year.
And I also think, just what we talked about before, the buyer profile is shifting. So you have digital asset treasury companies, you have these Bitcoin ETFs with all the different institutional clients that are increasing their ETF holdings. I just think the marginal buyer is different than it was in previous cycles. So it's plus if you think about we have state treasuries potentially coming online, state of Arizona, New Hampshire, and others. I just think in the future there's going to be a different set of buyers than there was in the past, and it'll be, like Bill said, I think it's kind of less relevant, muted going forward.
And then it's been a tough environment for altcoins. What do you guys, obviously we're at the BTC conference, but what do you think about the investment opportunity for Bitcoin relative to some of the altcoins that are out there?
So we're actually seeing, I think some interest from advisors at least for ETH sold, but I think from a 21Shares perspective, we don't really view alts as having kind of another alt season as we did in the past. Not all tokens will accrue value like they did in the past. I think it's sort of more about, what are the actual, what's the actual adoption? What are the fundamentals of these networks? Like hyperliquid, right? That's a great use case. For example, these prediction markets, right? But then there's a lot of sort of tokens out there that may not necessarily accrue value in the future. And then blockchain tech will be used sort of on the back end for a lot of corporates that are adopting, this new technology. And I think we may not have the same type of alt season as we've had before. But
Yeah, to add to that, which I agree with, I think you have to go back to first principles and try to assess, why were there altcoin investors to begin with? What was their goal? What was their motivation? What were they trying to unlock? And if you simply just think that it's driven by financial speculative purposes, the reality is there's two kind of trends that have emerged since the COVID years that compete for that capital, right? The two things I would broadly mention is one, the rise of zero-day expiry options has been unstoppable. That market is humongous. I think now it accounts for more than 60% of daily trading of listed options for NASDAQ. And so, zero-day expiry options competes with some speculative fervor. The other thing that has happened is the rise of prediction markets. And that also demands a certain kind of retail participation with an edge towards speculative behavior. And if you think that we're in a closed-end system where these are capitals that are being competed for, that is one of the challenges I think the altcoin complex has. That being said, I think there could still be winners of complexes that find true value accrual mechanisms that are useful genuinely to consumers that they service. But I think this idea of like altcoins as a construct, almost like as a basket indexed approach towards representing an asset class might not be the same as it was in the past.
Yeah, I mean, I think hyperliquid is one of the most impressive stories I've seen, and especially during this war, all eyes have been on the oil futures trading on hyperliquid. With that said, I think to be honest, I kind of appreciated this cycle for altcoins more so than the past. In the past, in 2017 or 2020, it was like, hey, our blockchain or our token's going to solve world hunger, and it can do anything. And this cycle, it was like, hey, this is called a rug pull token, and you can buy it on Pump Fun. And so it was a bit. I feel like the Solana speculation was a bit more honest in a way. And I think there's been some troubles with DeFi lately. I've seen some soul searching from like the DeFi crowd. A lot of this isn't truly decentralized, and that's fine. I don't think everything needs to be a decentralized distributed ledger, but I will say, I mean, there certainly is a lot of value in the rails, right? And so, if you're a big purchaser of Bitcoin, like a Metaplanet, well, settling in dollars sometimes takes, wiring from yen to dollars, from Japan to the United States takes a long time. But a stablecoin settlement takes, 1 second. And so there's value there, I think, in the infrastructure. But yeah, I think I'm pretty bullish on Bitcoin dominance personally. In terms of I don't think it's the best metric in the world, but just in terms of the liquidity and the market participants, I think this is a winner take most market.
So it seems like it's been months that every time we get to 79, I'm like, here we go, and then we sell off, right? What's going to drive the next bull market? What's going to get us back to the 80s, 90s, hopefully hundreds at some point soon?
Well, I think stretch is going to play a big part. I think there will be some clarity on the political front, and I think hopefully on the war. I think Bitcoin's responded pretty well. The fact that it didn't make new lows, and I think also just the overlay of the Hormuz toll booth kind of story, kind of Bitcoin has reemerged in the minds of maybe some allocators as okay, this is actually more of a gold-like bucket and less of a software stock bucket, and so that shift it's still trading like risk, but I think that shift in the minds of the allocators is positive, and so who knows when the return to 100K happens, but the negative funding and kind of this constructive range I think is a good start.
So we'll end on this. If we run it back, get this conference and get the panel going again in Nashville next year, and we say, okay, what's the price? Do you guys have any predictions in a year? Anyone bold enough to make a prediction in a year's time on the price of Bitcoin?
I guess I'll start. I'll say, I know this is kind of general. I say if we do 150, 200, I think that'll be. I think that a lot of the macro questions that we have right now that we've all kind of mentioned, I think it'll be cleared up. I'm going to be probably pretty optimistic that it's going to be cleared up, so then we can see a little more. Again, we have a new Fed head coming in. We have a lot of the political situation coming in. So I think with the regulatory environment improving, I would say, a more positive level, I would say that we're going to see 150. And again, 150 is 100. I mean, it's a lot. Maybe it's a lot to ask for. Perhaps we revisit all-time highs, and then we could see what happens from there. But I don't really see anything above 200 after a year.
20 million yen. I think over new all-time highs this year or before next year would be maybe my base case.
Well, let's give a round of applause to our great panelists. Thank you all for joining.